Mistakes to avoid when investing your money. 8. Having low liquidity. Liquid assets are those that you can sell quickly. They consist of things like cash and money market instruments. Having low liquidity can put you at serious risk, especially if something happens and you need money to keep you afloat. Most experts recommend keeping at least enough to keep you supported for 1 or 2 months. However, it does depend on each person's individual living situation. Just think about what you would need if the market were to close suddenly. 7. Reacting to media. You may get into the habit of watching media for information regarding the investment industry, but relying on it too much can negatively affect you. The media likes to make things look worse than they actually are as a way to induce fear. This can then cause a panic in the market, which leads to irrational decisions. Still, make sure to keep yourself informed, but don't go being impulsive until you have fully assessed the entire situation. 6. Paying too much in commission. Once you start investing, take care to not spend too much on trading commissions, which are the fees your brokerage charges for each trade you place. Aim to pay no more than about 2% of the value of your trade in commissions. For example, if you were placing a $1,000 trade, you'd spend no more than $20 on commissions. Many good brokerages these days charge $7 or less per trade, so you can make relatively small trades and not exceed 2%. A $7 commission would be 2% of a $350 trade. If you placed a $100 order, though, a $7 commission would represent 7%, and you'd need your investment to grow by a full 7% just to break even. 5. Investing before you are ready. Never invest until you're ready to, financially and mentally. Pay off your high-interest rate debt before you start investing. If you're deep in debt and paying, say, 17% in interest annually, any money you spend on stocks would have to earn more than 18% just to keep you from losses. Over long periods, the stock market's annual returns have averaged close to 10%, not 18%, with many periods featuring significantly less than that. It's also smart to have a fully stocked emergency fund in place before you start putting money in stocks. Aim to have 6 to 12 months worth of living expenses easily available. Without an emergency fund, a costly car repair or unexpected medical bill can force you to sell your stocks at a bad time, such as when they've temporarily fallen in value, causing you to lose out on future gains. 4. Trusting wrong sources. Many new investors put too much faith in talking heads on financial TV programs or in hot stock tips offered by a friend or colleague. Anyone can recommend a stock, but you rarely really know the track record of the recommender, and even a great investor will make some bad calls. Remember, anything that sounds too good to be true most likely is. 3. Buying penny stocks. Penny stocks are stocks trading for less than about $4 a share, and many are priced below $1. The fact that you can grab thousands of shares for a few $100s, or less, can be appealing to beginners. That's trouble because penny stocks are often tied to unproven, unprofitable, and sometimes shady companies. They're also frequently very volatile and easily manipulated by scammers. Scammers buy shares of the stock, hype it up online or in articles so that others buy in and driving up the price, and then the scammers sell their shares, causing the price to plunge, leaving the other investors with big losses. It's called a pump and dump scheme. A stock priced at just $1 per share is not necessarily a bargain and can be more likely to fall to 50 cents or 10 cents per share than to double or triple. Meanwhile, a $200 stock can be a bargain, doubling or tripling within a few years. 2. Not diversifying. Not diversifying enough is another common investing blunder, and it's not necessarily addressed by you owning, say, 20 different stocks. If 10 of those are energy companies and 10 are manufacturing-focused companies, you're not that diversified. A sudden drop in the price of oil or gas could change the fortunes of half your portfolio, as could a recession that has manufacturers slowing down. Aim to be invested in a range of industries and ideally, a range of countries, too. Go ahead and focus on US-based stocks, but consider adding some international holdings, too, or some big US companies with sizable foreign operations. 1. Not evaluating your performance. We investors should be assessing our own performance regularly. Since any of us could invest in a good low-fee S&P 500 index fund, if we're investing in individual stocks, it makes sense to aim to outperform the S&P 500 index. If we don't do so over a period of years, we'd do better just keeping our money in the index fund. Don't throw in the towel after just a single year, or maybe two, of underperformance, though, but try to assess how well you're doing over a few years. If you keep reading and learning about investing, you may refine your strategies for the better over time, too.